Today, we're talking about Roth IRA rules and the top 7 Roth IRA mistakes to avoid. The whole point of a Roth IRA is to save for retirement. So make sure you don't make any of these costly errors that will chip away at your retirement nest egg. First, a quick refresher on the Roth IRA. IRA stands for Individual Retirement Account. With a Roth IRA, you contribute with after-tax dollars. This basically means you can withdraw your contributions, the money you've put into your Roth IRA, completely tax-free at any time. That's because you've already paid taxes on this money. Earnings, on the other hand, are slightly more complicated and one of the top mistakes we'll be getting into later in this video. What's more, with a Roth IRA, you don't have to take required minimum distributions starting from age 72. This means that if you're in the lucky position to not need your Roth savings when you turn 72, you're not required by law to withdraw anything. The maximum amount you can contribute to your Roth IRA in 2021 is $6,000 if you're under 50 and $7,000 if you're 50 or older. And if you're watching this before the extended tax deadline of May 17th, 2021, and you didn't max out your Roth IRA contribution limit last year, you can still fund your Roth IRA for 2020 up to that $6,000 limit before the May 17th tax filing deadline. And at the same time, you can contribute another $6,000 for 2021. Something to think about for those that got some stimulus money. For those of you new to us, welcome to Diamond NestEgg, the #1 place to learn about money, investing, and retirement. I'm Jennifer, and I've spent most of my life in finance. Started working at banks like JP Morgan and Goldman Sachs at the age of 17, and graduated top of my class from NYU and Harvard Business School, studying, you guessed it, finance and business. And now I work with companies like Bloomberg, WeWork, and Walker Edison, teaching their employees all about financial literacy and education. Please note that Diamond NestEgg is a financial literacy, education, and coaching company, and that I'm a licensed insurance broker. We are not a bank, securities broker, legal, tax, or financial advisor. And for those of you who want an update on my left leg from my bad roll down the mountain over Easter weekend, I'm still on crutches. I got my MRI a few days ago. And if you've ever gotten an MRI, you know how claustrophobic and piercingly loud the whole thing is. Yeah, well, I fell asleep a quarter of the way through. We still haven't gotten the MRI results or our health insurance bill yet, but once we do, I'll give you a rundown of our medical costs. So let's dive into those Roth IRA rules and the top 7 mistakes to avoid so that you can have the biggest retirement nest egg possible. Mistake number 1, not earning enough to contribute. You cannot contribute more to a Roth IRA than you receive in earned income for the year. According to the Internal Revenue Service, earned income includes wages, salaries, commissions, bonuses, tips, and net earnings from self-employment income. It can also include long-term disability, union strike benefits, military differential pay, and taxable alimony. Dividends, interest, or capital gains are not considered earned income in this case. You can contribute to a Roth up to the allowable limit for both you and your spouse as long as you file your taxes jointly and one of you makes enough eligible income to fund the contributions. Mistake number 2, earning too much to contribute. You can earn too much to contribute to a Roth IRA. Whether you're eligible for a Roth IRA depends on your MAGI, or Modified Adjusted Gross Income. MAGI is essentially your income minus certain deductions such as contributions to a traditional IRA, student loan interest, tuition and fees, and foreign earnings. The income limits for Roth IRAs are adjusted periodically by the IRS. You guys know we love charts, so here we go. In 2021, if you're filing as single, head of household, or married filing separately, meaning you didn't live with your spouse at any time during the year, you must earn less than $125,000 to contribute the maximum amount to your Roth IRA. If you earn between $125,000 and $140,000, you can contribute some money, but the amount is reduced. And if you make $140,000 or more, you can't contribute to a Roth at all. If you're married filing jointly or a qualifying widow or widower, you must make less than $198,000 to be able to make the maximum contribution. Between $198,000 and $208,000, the allowed contribution starts phasing out. And at $208,000 or more, no contribution is allowed at all. There's an option to create what's called a backdoor Roth IRA if you exceed the income limits we've just talked about. But we'll save that for another video, or this one's gonna be way too long. And if you're enjoying this video so far, please show us some love and give that thumbs up and subscribe button a love tap, or leave us a comment below. YouTube loves that lovin', and so do we. It also helps push this video out to others like you who are trying to make as much of their retirement nest egg as possible. So, mistake number 3, contributing too much. Getting a boost in your income is great news, but given the Roth income limits we just talked about, be careful that you don't contribute more than the allowable maximum contribution of $6,000 or $7,000 if you're 50 and over. You should also pay attention if you have more than one IRA. This maximum contribution limit is for all your IRAs in total, not per IRA. Excess contributions are taxed at 6% per year. For each year, the excess amounts remain in the IRA, with the tax not to exceed 6% of the combined value of all your IRAs at the end of the tax year. To avoid the 6% tax on excess contributions, you must withdraw the excess contributions from your IRA by the due date of your individual income tax return, including extensions, as well as any income earned on the excess contributions. There are some more specifics around this, so if you have any questions, please email us at jennifer@diamondnestegg.com. Mistake number 4, pulling out earnings too early. At the beginning of this video, we said that you can withdraw your Roth IRA contributions, the money you put into the account, tax-free at any time, because you've already paid taxes on these contributions. You can also withdraw Roth earnings, your investment gains, tax-free and penalty-free, as long as your Roth meets the 5-year rule and one of the following applies to you. 1, you make the withdrawal at age 59 and a half or older. 2, you're withdrawing because you're permanently disabled. 3, the withdrawal is made by a beneficiary or your estate after your death. Or 4, you use the withdrawal to purchase, build, or rebuild a first home for yourself or a qualified family member. If, however, you don't meet the 5-year rule or one of the conditions we just stated doesn't apply to you, you may end up owing income taxes as well as a 10% penalty on any earnings you withdraw. So be careful. Take a look at this Roth IRA withdrawal rules video here for a full explanation of the Roth IRA 5-year rule and how to avoid paying taxes and penalties on your Roth IRA withdrawals. Mistake number 5, forgetting your beneficiary list. So many of our clients forget to do this, or they forget to update their beneficiaries regularly. Always keep your primary and contingent beneficiaries for your Roth IRA current, and for all your accounts for that matter, whether that's an IRA, 401k, life insurance, or will. I generally recommend doing this at least once a year, and especially when you have a significant life event, like getting a new job, getting married, getting divorced, or having a baby. A primary beneficiary is the person that inherits your Roth IRA or other assets when you pass away. And the contingent beneficiary is the person that inherits it if your primary beneficiary passes away. You can have one or more primary beneficiaries and contingent beneficiaries. Seriously, the last thing you want to do is leave your hard-earned savings to an ex-girlfriend, ex-boyfriend, or former spouse. Even a divorce decree by itself won't prevent a former spouse from getting your assets if he or she is still listed as a beneficiary. Guys, if you're enjoying this video so far, we'd really appreciate a thumbs up and a subscribe. This really helps catapult our video up the YouTube ranks and helps us grow our personal finance community here. Or drop us a comment below and let us know, have you made any of these mistakes? So mistake number 6, not opening a Roth IRA because you already have a company 401k. The original goal of the IRA was to give Americans that didn't have an employee retirement plan a way to invest in their retirement outside of work. But there's no law that says you can't invest in both. In fact, all of our clients open a Roth IRA as soon as they've maxed out their company retirement match, primarily because IRAs give you a greater variety of mutual funds, index funds, stocks, and other investment vehicles to put your money in. You can take a look at our retirement video over here to learn more about the difference between company 401k plans and personal IRAs and how to best utilize both. Or take a look at this Investing 101 video here if you're interested in learning more about mutual funds versus index funds versus ETFs. Mistake number 7, not contributing for your spouse. As we talked about in the very beginning, you can't contribute more to Roth than you've earned in a given year. The important exception to this, non-working spouses, as long as you're legally married and you file a joint tax return. There's no such thing as a joint IRA, but a spousal IRA allows a non-working spouse to establish an account and then have the working spouse make contributions to it as well as to his own. Of course, the working spouse's income has to be enough to cover both contributions. If this is you, really take this into consideration. Given the rising cost of retirement, increasing or perhaps even doubling your annual contributions is certainly not the worst idea in the world and could significantly increase your family's retirement savings over time. And if you still have some cash to stash away for retirement after investing in your IRAs and 401ks, consider setting up an HSA, a health savings account. This is a triple tax advantage account for qualified medical expenses that clients with high deductible health plans are using as an additional retirement savings tool. This HSA video over here will go through all the ins and outs that you need to know about these health savings accounts and high deductible health plans. Thanks for watching, guys. I hope this video will help you avoid or correct any Roth IRA mistakes that would have cost you a bit of money and diminished your hard-earned retirement savings. If you enjoyed watching this as much as we enjoyed making it, don't forget to give us a thumbs up and hit that subscribe button. We'll be back in a few days with another money-saving, wealth-building video just for you.